in the Monday lecture, you have a snow day. So this is the recording for what you would have missed in class. This week, we were going to cover or start covering off Chapter 9, which is non-current assets. You remember from the balance sheet, there was our asset section, which is current assets, and then long-lived assets. So long-lived assets was property, plant, and equipment, intangible assets, things like that. We covered in Chapter 7. So we did all of that. Then we go into the liability section of the balance sheet. So in the liability section, you have current liabilities, which we covered in Chapter 8. So think accounts payable, accrued payables, payroll taxes payable, various questions that we did like that. And now we're into non-current liabilities. So as we spoke about, non-current liabilities was the ones that were obligations or things that your business owes that are payable after 1 year. So as long as you're paying for it after more than 1 year, that's what we're talking about here. We'll talk about a few different examples, but most of the chapter is focused on debt. So when you take we'll call a long-term loan, how do you account for that? What do you do when you borrow the money? How do you calculate the interest? How do you record the interest? What do you do when you have to repay the money back to your investor? All of those types of things. We'll do lots of practice questions, and then there's a lot of additional material posted as well. For your midterm, this is most definitely one of the chapters where you'll get a short answer question on calculating or doing the accounting for a bond. So keep that in mind as you prepare for the midterm. Okay, so then in non-current liabilities, when we're thinking of non-current liabilities, one of the general principles that we think about is debt versus equity. So when you have a business, there are two ways for you to generate income, or not income, but to generate capital. So raise cash for your business. The first one is by borrowing money in the form of a loan or issuing debt. And issuing debt simply means I, as a business, am going to issue an investor a bond, and I'm going to pay interest on that bond to the investor. And in return, the investor is going to give me a bunch of cash. And then after a number of years, when the bond matures, then I'm going to return that cash to them. But most likely throughout the period, I am giving them interest payments as income for them investing or lending money to my business. So that is debt. That's a liability. The other way you raise capital for your business is through issuing shares. Now, when you issue shares, you're giving up a piece of your business or giving up some level of ownership. But in return, the investor is participating in the growth of your business, assuming your business grows. And if your business doesn't do well, then they're participating in the loss. So they stand to lose money if your business doesn't do well. So those are the two ways you generate capital for your business, and we'll kind of focus more on the debt side of things as opposed to the equity. All right, so we'll go to the next slide. Now, when you think of debt and equity, when you're focused on debt, there are certain advantages for your business, but there are certain disadvantages as well. So on the advantage side, you would have shareholders maintaining control of the business. So when you're issuing debt, you're giving away none of the ownership. So the people that started the business or that have controlling interest don't have to give away any of that control of the business. They continue to be able to make the business decisions and run the business the way they want. The other thing is the interest that you pay on the debt, that is tax deductible. So you'll remember from Chapter 8 when we were talking about taxes, the more in taxes your business, or the more income your business generates, the more in taxes you pay. So interest is one of the things that lets you reduce your income. So if you're reducing your income, you are paying less in taxes. And then the third thing is when you have or when you are issuing bonds, particularly at lower interest rates, then that allows you to bring in capital that can grow your business and generate more returns for your business. Now, again, this is all assuming that you use the money wisely and use it in growth potential for your business and actually generate money from that, or generate more of an income than the interest you are paying out. So that's advantages. On the disadvantage side, when you take on a lot of debt, so think of you personally, if you have a lot of debt, you might end up in a position where you're unable to make your interest payments or repay the debt over time. And if a business ends up in that situation, then you end up having a risk of bankruptcy. Risk of bankruptcy simply means, you don't have enough money to pay off your liabilities. And if you don't, and the bank comes calling or investors come calling for their money back, then you have to liquidate your business and shut things down. So that's a big risk. Another disadvantage is when you borrow money, you are borrowing money through debt with the assumption that you're going to be able to generate income in your business, and there's going to be that steady amount of cash flow. If you are not generating a steady amount of cash flow, you're unable to make interest payments. And if you're unable to make interest payments to your investors, then that's going to be an issue. But even making the interest payments themselves negatively impact the cash you have available to use in your operations. Now, the assumption is all of the debt you took on is available for you to generate income with. But again, paying interest does put some strain on the cash flows of your business. So those are a couple of things to consider. When we're into debt, or when we're talking about debt, there's various forms of debt that your business could take. You could take just a conventional bank loan, go and borrow money from the bank through a line of credit or an actual loan. Fairly straightforward. You could do it through notes, and we talked about that in the last chapter. Notes are similar to bonds, but they usually tend to be in shorter term. So, one or fewer, 1 year or shorter time than that. You could borrow a mortgage. So, you're buying a building, you mortgage your property. And so that is a form of a loan. Usually with mortgages, you're putting security as the thing you're borrowing against. So if you're buying a building or a piece of land and you're mortgaging that, usually the security you're giving the bank or your lender is that building or that piece of land itself. And then the last one that we'll focus most of our time on is bonds and debentures. Very similar. Won't get into sort of the nuance of each one, but just understand that this is a type of borrowing where you're issuing, a piece of paper to your investor that guarantees that in the future you will pay them back a certain amount of money. And we'll go into kind of all the variations of that. Now, when you are issuing debt in a public market, or you're just issuing debt in general, there are usually a few different people that you get involved. It's not just you could write a piece of paper yourself and go into the market and say, hey, I'm selling a bunch of debt. It doesn't work like that. What happens is you have to first prepare what's called a prospectus, which is a large document that highlights multiple years of financial information about your business. Usually those financials have to be audited. There's also other information about what your business does and general information that would help investors understand the type of business you have, understand the risks associated with the investment, things like that. Usually the prospectus is prepared by an underwriter or investment bank that helps put all of that information together. Usually the auditors are involved. It's not something that you would prepare by yourself. Then you have the underwriters. The underwriters are sort of middlemen, let's say, that would be involved with facilitating the borrowing. So they would go out and help you prepare the prospectus. They would also help facilitate sort of investor meetings so that they can circulate the prospectus with potential investors. And generally, they're involved with trying to make sure that people know that you are issuing this debt. And then when people know about it, then there's more people that would be interested in giving you money. And then the last one is the trustees. The trustee is usually involved somewhere in the middle as well, and they're just making sure that the deal goes through the way it's supposed to go through and everyone is meeting their obligation. Question, Justin?
So, the prospectus is the documents. Is that the one that written by the investment bank in general?
Sorry, say that again.
The prospectus, is that the one written by the investment banks?
Yeah, usually that's the one the investment banks help you put together. So, like I said, it's got background information about your business. It's a bunch of additional marketing material, but the main part of the prospectus is 2 or 3 years of financial statements, usually 3 years of financial statements, and those need to be audited. So they'll help you put together, what a standard prospectus looks like. For public markets, there's usually minimum requirements of what information needs to be in there, and that's where the iBankers make all their money. Between that and marketing, um, that's where the underwriters get involved, and they usually keep somewhere between 0.5% to 2% of all the proceeds of your debt offering. So let's say you were to offer, like you're raising $100 million for your business through a debt offering, then the underwriters would usually keep 2% of that for doing all the work, the marketing and finding investors and stuff like that.
Just to clarify that the
Mhm.
underwriter is the one that like third parties that helps to issue the bond, like investment banks, right? And they also write the prospectus. Is that right?
They'll help you write the prospectus, yeah. So you have to give them all the information, they help you put it all together.
Okay, so like for example, investment banks will be both in this case.
Correct. Yeah. So
Okay,
and think of investment banks and underwriters as sort of the same thing. They're just the middlemen facilitators for everything,
okay, got it. Thank you.
right?
Thank you.
The investment bank isn't the one that's giving you the money. They're helping you connect with people who have money that will lend to your business.
Copy that.
All right. Okay. So we keep going. All right. So in a bond, there's usually certain things that are fairly standard, and every bond will have them. And you need this information in order to calculate the value of the bond itself. Okay. So in this particular example, this was right out of your textbook. Um, this is a bond that, let's say, Amazon was issuing. And the first thing that you find on any bond will be the principal amount, which is the face value of the bond. Like, how much is this piece of paper worth? There's different terms sometimes that are used for that. So it's called principal or face value or par value or maturity value. It simply means that when you come, so you give the company a certain amount of money, and this can be more or less or the same as the face value. But when you redeem the bond at the end of the term, so let's say after 10 years, the bond is like the term is finished, and you give back the piece of paper to the business, that the business has to pay you the face value of the bond at the end of the term. So principal is the first piece of information you're looking for. The second thing you're looking for is the term, so how long the bond is running for. That's usually expressed in, a certain number of years. So in this case, it's 5 years. So that means for 5 years, the bond is going to pay out interest, after which you have to redeem it. The third thing you're looking for is a coupon rate or an interest rate, sometimes called stated rate, contract rate, nominal rate. Any one of those terms usually will be expressed as an interest rate. That interest rate is telling you the percentage of interest that the bond is paying. So, to your question, is this compounded or not? Usually, bonds will pay out a straight interest rate on the face value of the bond, so not compounded. Compounded would usually be on like there is a type of bond that can do that, but that's outside the scope of what we're doing because we're going to be manually calculating some of these. So we're not going to get into compounding just yet. Okay. And then the last one is you're looking for frequency of interest payments. So when we're talking about frequency, this is just saying, are you going to get interest payments once a year, twice a year, 3 times a year, things like that. The one thing to keep in mind, though, is that the interest rate that's given on a bond is an annual interest rate. So 10% means it's going to pay a 10% interest for the year. So if you're paying interest 2 or 3 or 5 times during the year, it will still all add up to 10% of interest on the face value of the bond for the year. Okay. Um, Now, when we said earlier that there's different types of bonds, there is, well, this is an example I pulled or a visual I pulled right out of the textbook again. There's, an unsecured bond or what's called a debenture. And that simply means that there is no assets pledged against the bond. So if the company goes bankrupt and they can no longer pay the bond or the interest, then there are no assets which the business has offered as security against the bonds. So the bondholders would lose their money. This is probably the riskiest type. So you'd usually end up having to pay a much higher interest rate, and you'd usually scare off most investors that are expecting some type of collateral or security against the money that they're lending to you. Then the next type is a secured bond. So a secured bond is the opposite of a debenture, which is when you have some security against the bond. So let's say you go bankrupt, but you have secured or guaranteed the bond against, let's say, the building that your company owned, then the bondholders have the first right to any money that comes from selling that building. Okay, so that's a secured bond. Then there's a callable bond and a convertible bond. So callable simply means there is what's called a call feature. And a call feature means that somebody has the ability to redeem the bond early. So in this case, when it's a callable bond, the assumption is that the issuer, so the business, let's say it's a 10-year bond, and they decide 5 years in, they want to buy back the bonds. Then they have the option to buy back the bonds from the investors. They don't have to keep the bonds open for the entire duration. The opposite of this is a retractable or mandatorily redeemable bond. Again, you don't have to know all the terms, but just for knowledge sake, this is the one where the investor has the option to give the bond back early, and then the company has to give them back their cash. And then the last one's a convertible bond. This basically means at some point you can convert the bond instead of for cash, you're going to redeem it for shares in the company. So what the issuer is doing or the business is doing is saying, we're going to borrow money as a bond to start out with, but 5 years from now when our business is further along, then we will redeem your bond for shares at a previously arranged value of the bond, and we're going to give you shares in the business then. We're not going to give you upfront. We're going to give it to you later on in the cycle. Different reasons for doing different types of bonds. The one we're going to focus mainly on is what is likely going to be, a secured or an unsecured bond. But the characteristics of the bond depend on the type of business you have, what investors are looking for, and what you as a business are able to offer them. Okay. Now, when you have a bond, usually the bonds will have conditions. Okay, so these are conditions that the investor is putting on the business. And these conditions or restrictions are in accounting terms or in business terms called covenants. Okay, so for accounting purposes, usually what happens is there are very common covenants that say that the business must maintain what's called a debt to equity ratio. And we'll talk about, those ratios at the tail end of this chapter. It also says, they must have a minimum interest coverage ratio. Sometimes there is an inventory turnover ratio that they must maintain. And then there's the limitations on the payouts that the business can do, which is basically saying that unless our interest is paid, you cannot go out and declare a dividend and start paying out a dividend to your shareholders because you might pay out a bunch of money as dividend shareholders and nothing left to pay the interest. So sometimes these types of restrictions are quite common when it comes to loans and any form of borrowing. And it's basically a way for the lender to try and guarantee that they will continue to get paid. Okay. Now, if you were to breach a covenant, so if you don't meet one of these conditions, you break a condition, then most times the lender has the option to ask for all of their money back right away. Most times the lender won't do this because it would usually immediately bankrupt the business that they've lent money to, but they'll usually trigger some kind of negotiation that will ask the issuer, so the business, to try and fix the issues that they've created or the covenants that they've breached. Sometimes involves them seeking additional funding from somewhere else. Sometimes it will ask them to cancel, certain transactions that they have done, depending on what the nature of the covenant breach is. But the one thing you want to take away is if a covenant is breached, usually that allows the lender to ask for their money back right away. And that's a big, big deal. Okay, now when you get further up in accounting, you'll learn about additional disclosure requirements when you breach covenants. You will learn about what happens to the accounting when covenants are breached, but it's early in accounting right now. We won't get into all of those details yet. Okay, so now we get into the main part of this particular chapter, which is how do you calculate the price of a bond? Now, intuitively, you would think, okay, go back here, I've issued $1,000 bond on the face, and the investor is going to pay me $1,000. And then over time, I'm going to give them a certain level of interest. But that is all assuming that the interest rate that you are going to pay the investor is what would be considered the market interest rate for your bond. And usually what would happen is the bond will have an interest rate that is different than what the market interest rate is. Okay, so that's something to consider, that you aren't always paying an interest rate that is the same as the market interest rate. So what you would account for is going to, most times, not all the time, be different than the face value of the bond. So if we go back here, the way to figure out how much you are going to account for the bond, so how much of a liability you're going to have, you have to do two things. You have to first calculate the present value of the principal, so the face amount of the bond, and you need to calculate the present value of all of the interest payments at market rate on your bond. Okay, now present value assumes that all of the money that you have, there is time value associated with it. So $1,000 today is going to be worth more than $1,000 5 years from now, because 5 years from now, you're assuming that there is going to be 5 years worth of inflation, and your $1,000 will be able to buy less in the future than they can now. So when you're doing this calculation, what you're trying to do is you're trying to calculate the value of the money today for all of the payments you're making in the future, okay? Which is why it's called the present value of the money. Okay, so simple formula when you're calculating the price of a bond, you are taking the present value of the principal and you're adding in the present value of all of the interest payments. Now, as we talked about earlier, if the rate your bond is paying, so you remember the coupon rate I showed you earlier, which is this right here, the interest rate your bond is paying is the same as the market interest rate, then the liability that you are recording is going to be the face value of the bond. Okay, because that accounts for the present valuing. So when you adjust for time value and you're paying the same as a market rate, then the present value of your bond is exactly the same as the face value, which is what we call the par value. But if your bond is paying a higher than market interest rate, okay, that means your bond is worth a lot more than what the market rate is, then your bond is effectively being issued at a premium, and therefore the liability you record is higher than the face value. And the reason for, like, if I were to give you a piece of paper that says 5 years from now, this piece of paper is going to return you $100,000 if you invest $100,000 now, and I'm going to pay you a 10% interest rate for lending me this money. But if the market rate, so if you were to put that same 100,000 somewhere else and the rate of return you would get is 5%, then that piece of paper I just gave you is worth way more to you than investing it somewhere else. So if you were to try and sell that bond, someone would give you more than $100,000 for it because it's going to return them a much higher rate of return. And that's the assumption in all of this, is to say if your bond is paying higher than market rate, then the value that you record should be higher than what's on the face value. It's the opposite. If your bond is paying a lower than market interest rate, that means your bond or your liability is going to be below par value because that piece of paper is worth not as much because somebody else could put that money into a higher returning investment in the market. All right. Okay, so we're going to take one example, and this is the simplest example that you could get in a bond situation. Okay, so this is a bond that you are issuing in the market at par. Okay, and at par means the interest rate or the coupon rate on your bond is the exact same rate that an investor would get if they would invest that money somewhere else in the market. Okay, so in this example, we're saying on Jan 1, 2022, ABC Company issued 6% bonds. So that's your coupon rate with a par value. So remember we said it could be par, it could be principal, it could be called nominal value, face value, anything like that. Par value of $400,000. So that's the amount of money that when you redeem the bond, you would get back $400,000. And in return, the business received $400,000 in cash. The bonds mature in 10 years. Okay, so that's the term. And the interest is paid annually. So that's the frequency of interest payments. Market rate is also 6% annually. So remember, it's a 6% bond and the market rate is 6%. So what you're supposed to do when you're calculating the price of that bond, you're saying to calculate the value of the bond, I'm going to first start with the present value of the principal, and I'm going to add on to that the present value of the interest payments. Now, how do we calculate this present value? We need to pull out what is called the present value tables. So I posted on the Quercus something called the present value supplement. This is about 15 or 16 page document that Professor Dega had prepared once upon a time, and we all sort of leverage it. Very good document. It's a little bit technical, but what you're trying to pull out is page 15. So the document looks something like this. It's on the Quercus along with all of the Chapter 9 materials. But what you can give this a read, and it'll help you explain what time value of money is if you need a refresher on what that is. But you're scrolling down to page 15, which looks something like this. And you want to make sure you're on page 16, not on page 16, which looks very similar. The term you're looking for is present value. Okay, future value is something a little bit different. So this is a future value table on the last page. You don't want that yet. It's used for a different purpose. You focus on table 1 and table 2, which are our two present value tables. Now, when do you use these tables? When you're calculating the present value of the principal, which was the first thing in our slides. Remember, we're calculating present value of principal and present value of interest payments. Principal is a single payment. Interest payments are usually recurring, or what's called an annuity. So when you're dealing with the present value of the principal, you go to the first table, which says present value of $1. When you're calculating the present value of the interest, which is this here, you are then going to the second table, which is the present value of an annuity of $1. Okay, so now how do we calculate this? The way it works is we know that our principal is $400,000. We need to get the present value of that $400,000 that we have to pay out 10 years in the future. And to determine the value of that payment today, we need to go to the table with our market interest rate, which is 6%, and with the term that is 10 years. Okay, we go into the table. I know it's a little bit small, but if you zoom in, what you're looking for is the 6% interest up here, and you're looking for the number of periods, which is 10 periods over here. Okay, now in this case, since it's paying annually, you only need to go to 10 periods. If it pays semi-annually or quarterly, this changes, and I'll give you another example in the subsequent slides. Justin?
Professor, so this is calculatable on our calculator, right? Like we can just put I as the interest rate and N as the number of years. Is that correct?
Yeah, so if you use this formula up here, you can calculate this on your calculator.
And also, like, are you expecting us to remember this formula for the exams?
Am I expecting you to remember the formula? No. I will give you the present value tables on an exam. So
Okay, got it.
anything you need to calculate, you can just pull out directly by using the table. You don't need like a scientific calculator or anything like that. You could just use the table and you should be able to get the number you need.
And also like this present value is the present value because in here is like 10 years. This is the real value of the money of units 10 years later with the fourth. Is that right?
Correct. So it's telling you that inflation adjusted, if you were to pay $400,000 in the future, what would it be worth today? Right? So
Okay.
so it's calculating the real impact today of that payment you're making 10 years from now. And usually the real impact is much smaller because money much later in the future is worth less, right? Because of
Okay.
inflation.
Got it.
Cool.
Thank you. Thank you, Prof. Yep.
Yeah, no worries. So in this case, we were saying the market rate is 6%. The number of periods, so since it's annual, it was a 10-year bond. So we go across 6% and 10 periods should give you 5584. Okay. So when we come back to our let's get back to our slides. Where's our slides? This one here. Yep, there we go. If we come back to our slides, we're saying present value of the principal, 400,000 times 0.5584, which we got from our present value table, is 223,360. This is saying that the $400,000 that we paid 10 years from now is worth 223,000 today. Okay, because that's what 400,000 in the future will be. The next thing we're trying to calculate then is a present value of the interest payments. So the interest payments, and this should, yeah, okay. So the interest payments is the principal times the interest rate, which is 6%. That'll give you the interest payments that you're paying, times, and then this number we need to figure out from the present value table. So we go back to the table here, and now we're going to the annuity table, which is the second table. And we're saying 6% market rate, 10 periods. We go across 1, 2, 3, 4, 5, 6, should be 7.3601. Okay, so we go back to our slides and we've got 7.3601. Okay, so it's just the annual interest times the present value amount, which gives you 176,640. I wrote rounded down because I think this works out to 642. But to add this up to 400,000, just needed to round that down by $2. Okay, when you put the two together, you should end up with 400,000, which you know is correct because the bond you issued has the market rate and the coupon rate being exactly the same. When the coupon and the market rate are exactly the same, the face value of the bond is the same as the present value of the bond. So far, so good. Okay, so now that you've got this bond and you've calculated the value of the bond being, or the present value of the bond, which is the present value of the principal and the present value of the interest, you need to do some accounting. And that accounting starts with recording the cash that you receive from the investor. So in this case, it's very straightforward. You will get the full price of the bond as cash from your investor of 400,000, and you will record your non-current liability of $400,000. Now it's non-current because it's 10 years into the future. So because this is a liability that you owe 10 years from now, you can record the credit of 400,000 as a non-current liability. Okay, this is fairly straightforward. Debit asset, credit liability. Now, every year you're going to be paying the interest. So when you are paying the interest every single year, you have to record that expense for the interest. So the way to do that is you start with your debit interest expense of 24,000, which is calculated as the 400,000 times the 6% interest. So debit expense, 24,000, credit the cash you're paying out of 24,000. Every single year, you're going to make this interest payment, and you're going to do that. Then eventually, at the tail end, you are going to redeem the bond. So 10 years from now, your lender is going to come back, give the piece of paper, and say, I would like my principal back now. And at that point, you are going to give them back their cash. So you undo that first entry you made by just going debit liability, which is reducing your bond payable liability 400,000. This is always going to be the face value of the bond. Okay, at the end of the bond term, it is always the face value. The only time this number is not the face value is if there's an early redemption. So remember we talked about callable bonds, and partway through the term, somebody asked for their money back, or the business decided to buy back the bonds, then that number will be different. But otherwise, at the end of the term, it is always the face value of the bond. Okay, so debit bond liability, credit cash, which is your credit assets of 400,000. These are the three entries in principle that you always have for the entire bond cycle. So first, when you get the money, you have to make an entry. When you pay out the interest, you've got to make an entry. And then the last entry you make is when you redeem the bonds back, you've got to give back the cash, so you make an entry. Okay, the interest entry will happen multiple times because there's multiple interest payments throughout the period, but just to show you the entries you are making. Now, this is the simplest type of bond that you could have. Market rate equals coupon rate, all the interests annually paid. There's no premium or discount you're dealing with. So this is like the most basic. We will never test you on the most basic situation. This is only to illustrate all the elements working together. I will show you more complicated examples, and then we will do practice questions as well. Now, since this is a recording, I won't take a break. I'm just going to keep going. But for those who will listen to the recording after, you could take a break sort of as you need throughout the period of the recording. All right. Sorry, Justin, I know you're listening live, but you can come back to it later if you'd like. Okay, so the next example we look at is one where you are issuing using or issuing at a discount. Okay, so this means that the bond you are issuing is paying an interest rate that is lower than the market. And the reason it's going to be issued at a discount is because since you're paying a lower interest rate, the value of your bond to an investor is lower than what's on the face. Okay, so they're going to give you less money than the face value of the bond, because when they calculate the present value of your bond, it is lower than what the face value is going to be. And I'll show you how that works. Okay, so same example, January 1st, 2022, ABC Company issued 6% bonds par value of 400,000, bonds mature in 10 years. So those pieces of information haven't changed. The coupon rate's the same, the principal is the same, and the term is exactly the same. But there's two things that are going to be different now. First, interest is paid semi-annually. Okay, so now you're paying interest twice a year, not once a year. And that's going to be very relevant when we start using our present value tables. The second thing is the market rate is 8%. So remember in the first example, market rate was 6%, coupon rate was 6%. Now the market rate is 8%. That means if your investor was going to put the 400,000 in a different 10-year investment, they would expect to get 8% return, but you're only offering 6% return. Therefore, the investor would expect to invest less money than the full 400,000 to get back that same return. That's where the discount is. Okay, so once you have all of that information, that's everything you need to calculate the present value of your bond. First, remember the basics. Present value of the bond is present value of principal plus present value of interest payments. Okay, now when you are calculating the present value of the principal, you need three pieces of information. You are going to need the principal amount, which we know is $400,000, and you are going to need the payment frequency along with the market rate and the term. So the term and the frequency go together as one, and the market rate goes together again with the frequency. And I'll explain to you why that matters. In the first example we did, and we went to the present value table, we know that our period that was 10 years, and we knew it was 6%. But that was always assuming that you're paying interest once a year. When you are paying interest at a different increment, so in this case, twice a year, you now have to double the term. Okay, so in this case, it was 10 years. For the table, we're going to double that and make it 20 because it's twice a year. And for the interest rate, we are going to take the market rate and divide that in half. Okay, because again, you're paying twice. So it's sort of assuming that I'm going to pay the first 4% of the market rate in the middle of the year. I'm going to pay the next 4% at the end of the year. So to calculate the present value, instead of using 10 periods, 6%, we are going to go to the present value table. And for the principal, the market rate was 8%, so we're going to use 4% because it's paid twice, so 4 and 4 gives you the 8. And instead of doing the periods as 10 periods or 10 payments, we're assuming 20 periods because we're doubling the term. So it's 20 payments. So 20 and 4% would give you 4564. So 0.4564. If we go back to our example, it's principal times present value number, which is 4564. That gives you a present value of principal of 182,560. Now notice this 182,560 is lower than in the previous example because the interest rate and the term and what you're paying is a little bit different, okay? At the 8% rate, the time value of money reduces the value of that money even more. So that's why this principal amount is lower. Then we get into the second half of this, so present value of interest. So we just use the other table instead of the first table. So the interest payments are 400,000 times 6% would have been the annual interest payment. But remember, in this particular example, we're paying that interest twice, not once. So you have to reduce that annual interest rate in half and make it 3%. This should give you collectively $12,000. So each interest payment, you are paying $12,000. And you need to calculate the present value factor. So when we go to the present value factor, we said we need the market rate, we need the term, and we need the payment frequency. So in this case, our term is 10 years, paid twice, so that's 20. So our N in this case is 20. And then interest rate's 8%, but since it's paid twice, we're just going to half that and make it 4%. So we go back now to the second table because this is the interest, so we're dealing with the annuity. 4%, 20 gives you 135903. Hopefully I got right. Yeah, 135903. So you take each interest payment times 135903 gives you 163,084. When you add the two of these together, you are going to get 345,644, which is a value lower than the face value of the bond. And that's the discount we're talking about. That the investor was willing to give you less money for the same return because you are paying a lower interest rate. Justin.
Okay, can we explain why do we get the 13.59?
Where do we get this from?
Yeah.
Okay. So remember when you're trying to calculate present value, you have to figure out how many payments in this case you are going to present value. Okay. So in this case, for interest payments, it's saying you're paying interest twice a year. So the way interest is calculated, forget everything else. I, as a business, have promised you interest on a $400,000 bond at an annual rate of 6%. Okay, so if you do 400,000 times 6%, that's in the year I'm going to pay you that much interest. But I tell you, I'm going to pay you that twice a year. So that's simply saying that the 400,000 times 6%, which is 24,000, I'm going to give you that money in the middle of the year and the end of the year. So you're just going to make that half. And you know that you are going to get cash in your hand of $12,000 twice a year. Okay, so that's your starting point. Then you need to figure out as the business, for every time I'm giving that $12,000 out, what is the present value today? Okay, so you know that I'm going to make 20 payments, okay, which is, remember we said it's a 10-year bond and you're paying interest twice a year. So I'm going to make 20 payments. And the market rate for me to calculate present value is 8% annually. But since I'm making two payments, you have to take this 8% market rate and you're going to cut that in half.
Okay.
So you got it?
No, I didn't get the 13.5903. That's the
Okay. Okay.
I
Yeah. So I'm
Yeah.
getting there. So you know the two pieces of information you need to know when you're going to the table, this table here, which is the annuity table, is you need to get the number of periods you're making the interest payments. So we said 10 years paid twice a year is 20 payments. Okay, so my period is 20. And then
Oh,
you
this is
need,
the one we get from the table, right?
correct.
Okay,
And
got it.
then
Sorry. No.
yeah, you're all good. And then the other one is simply interest rate. So you're always taking market rate when you come to the table. And market rate, since it's paid again twice a year, you have to cut the market rate in half. So it started 8%. We cut that in half to make it 4%. Just go 4%, 20 periods, 135903. Make
So,
sense?
one more question. So in this
Yeah.
case, we only take the 8% market one. We don't take the 6%. Is that right?
So when you're coming to the present value table, you only care about market rate. You don't care about the coupon rate.
Okay, got it. Thank you, bro.
No worries. Okay. Let's come back to our slides. Okay. So now that you've calculated present value of principal and you got the present value interest, you can record the first of those three entries we were talking about. And that is you getting cash from your investor. But the investor said, you're paying below market, so I'm not going to give you the full 400,000 you're asking for on the bond. Instead, I'm going to give you what the present value of that bond is. And the present value based on my market rate calculations is 345,644. So you're like, okay, no problem. You take the 345 and you record debit cash, which is plus assets, so the cash coming in, credit bonds payable of 345,644. This is your non-current liability. Okay, so now this number is lower than the face value of the bond. So you need to keep track of the discount that you offered on the bond. Okay, so you track that separately, so it would be a contra liability. So on the balance sheet, you can either directly record the 345,644 as your non-current liability. So you just say bonds payable 345,644, or you can record it as credit liability or credit bonds payable, the amount showing the full 400,000 face value, and then you record less discount on issuance of 54,356, right? So think accounts receivable, the same way you do it, show accounts receivable, less allowance for doubtful accounts. Same thing for inventory provision. So same logic here. You could just show the full value of the bond, 400,000, less the 54,356 as the discount, and then net bonds payable of 345,644. But at the end of the day, on your balance sheet, in the non-current liability section, you must have 345,644 when you are at the beginning of that bond issuance. Okay, now this number will change, and I will show you how, but when you start, it's got to have the full amount of the discount reduced. So then we skip forward and we go to what happens next. Now you're in the first year, you're in the middle of the year, and you say, I have to pay that first interest rate payment, which I promised to be at a semi-annual rate. So when you make that first interest rate payment after 6 months, you have to calculate how much you're paying and make the appropriate accounting entry. Except what you will pay and the accounting entry or the accounting entry based on the value you've recorded are not going to be the same. Okay, and I'll show you how that comes about. So when we are calculating the interest on the bond, or each interest payment for accounting purposes, we, for this example, are going to use something called the effective interest rate method. Okay, and the effective interest rate method is the method that is required or suggested by the International Accounting Standards, which is the ones we primarily teach you in class. If you were to use ASPE, which is the alternate method, you would use, which is like a simpler version of accounting, you could use straight line interest rate amortization, which I will show you in an example question, but later. For this method that I'm showing you on this slide, we're talking about the effective interest rate method. So that's just something you want to keep in mind. If we were going to test you in a question, we will specify for you which method you need to use for the amortization of the discount or the premium. Okay, so we'll always tell you use effective interest rate or straight line amortization. Just make a mental note that there's different ways to do this particular thing. Okay, so now in the effective interest rate method, which is the default method to use, you need to calculate what is the effective interest rate on this bond that you have issued. So not the actual cash you're paying in interest, but what you would have paid based on market rate and this actual amount that you've recorded as your liability. So to do that, you would take the value of the bond you recorded. So you remember we started with 345,644 on day one. You multiply that by the interest market rate of interest. So in this case, it's 8%. And since you're paying it twice a year, so semi-annually, you're doing times 6/12. If you were making 3 interest rate payments, then this would be 4/12. If you were paying interest quarterly, this would be 3/12. Okay, so if you were paying monthly, this number would be 1/12. Okay, so depending on the frequency you get in the question, you just adjust this last number to prorate the interest. So effective interest rate that we've got, the current value, or what's called the carrying value of the bond, times market rate times the prorated amount, so in this case 6/12, gives you 13,820 13,826. Can you do one over number of payments? So if we're doing, yeah, I think that should work. So if you do one over number of payments, let's see. So if you're doing monthly, it would be 1 over 12. If you're doing quarterly, it would be 1 over 4. Yeah, that would work fine. Okay. Um, okay, so this gets you, if you were to pay an effective rate, right, considering time value of money, you would have paid out 13,826. But the actual amount of cash that you paid was the $400,000 face value of the bond times 6% times 6 over 12 or 1 over 2, which is the semi-annual rate that you paid gives you $12,000. So you paid $12,000 in cash, but your effective rate should have been 13,826. There's a difference. So to balance that accounting, to make sure that your entry balances, that difference goes against the contra account you created for the discount. Okay, so if you come back here, you are going credit cash $12,000, which is the actual cash that you paid. You would have gone debit interest expense off 13,826, which is your effective interest. The difference between the two is now a credit to the bond payable of 1826. So what that does is it's taking the 345, 644, and gradually adding to it over time. And the reason you're adding to it is because as time progresses, you know that after 10 years, your bond liability is going to be $400,000 the face. Remember earlier in the slides, we said at redemption, you always pay the face value out to the lender. So we need to take our 345 and gradually work it up to 400,000. And that's what this does. This part of the entry gradually increases the liability. So in this case, it's a credit bond payable, 1826, increases the liability over time. So now this was the first interest payment. So now when you get to the second interest payment, the numbers are a little bit different. Okay, so when you're doing the effective interest rate method, you now again calculate the three things. You start with the effective interest rate, but in this time around, your effective interest rate, you're using the carrying value of the bond now, which means you start with the 345, 644, as we had on day one, but you're adding the 1826 from the first interest payment. Okay, which brings us the new carrying value of the bond, higher than before. And then you follow the same process from there on, right? So market rate times frequency. So in this case, 1 over 2 or 6 over 12, whichever one you want to use. And now you've got a higher effective interest rate payment. Okay, the actual interest rate is still 12,000, and you'll notice now that the increase in the bond payable liability is a little bit more. And then you keep working that up. And in this slide, it sort of shows you how it goes from 345 all the way to 400, just in question.
So the difference is will keep going up because of the number of years going up. Is that right?
Yeah, it's with time. So because the carrying value of your bond, you start with 345 to calculate effective interest rate, but now that base value, that carrying value is increasing each time you make an interest payment, right? That's why that amount that you're increasing on the bond keeps going up as well. That makes sense?
So
So when you started the first calculation you did, you used the original discounted bond value 345,644. But then on the next payment, the carrying value of the bond is 345,644 plus the first amortization amount of 1826. So your base that you're using has become a little bit higher.
so every time we have to add the either discounts where the premium on it. Is that correct?
Yeah, so every time you're adding and recalculating what the carrying value of the bond would be. Okay, now in the questions, if we were to give you, we're not going to make you do like 20 calculations and anything like that. We're probably just going to ask you what is the first payment or what is the first amortization of the interest rate, stuff like that. We might ask you the first one, maybe the second one, but no more than that.
The last
Yeah.
one, just every time when we use the effective ones, we always look at the market, and if we calculate the annuals, we look at the whatever it is on the coupon rate.
Correct.
Is it
So the actual payment is always based on the coupon rate and the face value, but the effective interest rate is the market rate and the discounted bond price or the higher, like the premium bond price.
thank you, Prof.
Cool. All right. Where were we? Okay. So this particular slide was simply showing you this is the actual interest paid from the beginning. This is the effective interest calculation. And then this is the difference, which is that amortization we're talking about. So in this case, the amortization is relative to that discount or premium amount, not amortization like we talk about in fixed assets, but the same logic is just saying that the number is changing or it's changing a value over time. And so that amortization is the difference between the actual interest and the effective interest. And it's in this case adding to the price of the bond because the bond has to get to the face value at the end of the term. Okay. When you're dealing in premium situations, I'll show you one of those examples later, you're going the other way. Okay, so you start at a higher than face value and you're reducing the value of the bond so that you can get to the face value by the end of the term. Okay, so you start in this case at 345 and gradually you keep adding this amortization in right till the end where you get to 400,000. All right. So practice question time. See if I can pull this open. 9-3. Okay. So we're going trend company issued 900,000. So we're going principal is 900,000. Then we're going term 10 years and 6%. So stated rate is 6%. On July 1st of this year. Interest is payable semi-annually. Okay, so frequency, I will write semi-annual, and then on June 30th and December 31st. Determine the issue price of the bonds assuming a market interest rate of 5%. Okay, so market rate of 5%. Now this one's a little bit challenging because what will happen is our present value table will not be able to split this and make it 2.5% because it's semi-annual. We have to divide this in half. So we're going to use the actual present value formula. So you get something else to look at in this example. Okay, so now we recall that to calculate the issue price, we need to first do the present value of principal, and we need to do present value of interest payments. Present value of the principal, we need the principal amount times the present value factor. So the present value factor in this case, our I is equal to, so our interest is market rate divided by 2 because it's semi-annual payments, so it's 2.5%. Our N, which is our number of periods, is 10 years, and we need to double that because it's semi-annual, so N is equal to 20 periods. So if we were to go to the present value table, what we would be looking for is I of, where is it? So we'd be looking for I of 2.5 and N of 20. We have the N of 20 down on the left corner, but there's no 2.5 being somewhere in the middle of these two. So instead, what we will do is we will use the formula off the top and manually calculate this table amount ourselves. So it's 1 over 1 plus I to the power of n. So we go back and is 1 over 1 plus I is 2.5%. So we'll go 0.025 to the power of n, which is 20. Just put a little equals in front of it. And that should give us a factor, and we always go 4 decimal places. So it should give us a PV factor of 0.6103. Okay. So this is an example where you get to use the formula, and I'll put the formula out separately so you have it for reference. Okay. So you've got the present value factor, you've got the principal, which is the 2 numbers you need. So the present value of principal in this case is principal times present value factor is 549, and we'll round this up. Don't want to use decimals, 549,244. Okay. 6103. So I will use the exact number here. So 0.6103, just so I get a nice, neat round number. Okay, so 549,270. Okay, so now we got the present value of the principal. We need to calculate the present value of interest payments. So our interest payments are going to be the principal of 900,000 multiplied by the interest rate multiplied by 1 over 2 because we are paying semi-annually. So each interest payment is going to be $27,000. For calculating our present value factor, we use the same inputs, which is 2.5%, and n is 20 periods. So we need to try and get to the factor. When we go back to our present value table, our annuity factor is, or the formula is this one here. So 1 minus 1 plus I to the power minus n. So let me write that down. 1 minus 1 plus I, in this case 0.25, to the power of minus n, so minus 20, and that's divide by, I think it was n, no, divide by I, so 0.025, so that's the formula that we're going to be using. We want to make sure that our brackets are in the correct spot. So I'm gonna have to do that, and then another one of these, and this should get us a present value factor of 15.5892. So 15.5892. So now we've got present value factor figured out. We've got our interest payment figured out. Just go A times B. So interest payment times factor should give us 420,908. All right. So we've got both of these. So our present value or our issue price of bond. And before we calculate this total here, we want to first think about what we expect this number to be. Okay, so our issue price is our face value is 900,000. The market rate is 5%, but the actual stated rate is 6%. So if our bond is paying an interest rate higher than the market, we would expect our bond to be worth more than the face value, i.e., it is issued at a premium. Okay, and if we're issuing at a premium, then this number, when we hit enter, should be higher than 900,000. And so we got 970,178. that should tell us that we probably got it right, okay? Or we were close if we didn't get it perfectly right. Okay, so we're going to switch and go back to the slides. Justin, you're okay with that one? Does that make sense?
So far, so good.
Okay, good. All right, so we'll go through the example, just through the mechanics of the theory for premium again. After that, we will do one more practice question and then we'll call it a day. Okay, so we'll go back to issued at a premium. And as I'm showing these slides, I realize I have a typo because the next two slides show this title being discount, so I'll fix that. Okay, so same example we've been using this whole time. We start with ABC Company. ABC Company is showing 6% bonds, par value 400,000. Bonds mature in 10 years, so our term is 10 years. Interest is paid semi-annually. Now the market rate is 4%. Okay. And at 4%, we are expecting that our bonds are going to be worth more than the face. The market is paying a low rate of interest. We are paying a higher rate of interest. Therefore, our issued debt should be worth a lot of money to the market. Okay, so go through the same mechanics as we did before. Present value of the bond using the PV tables should be 465, which is higher than the 400. That's the face value. How do you get that present value? You take the present value of the principal, add the present value of the interest payments. Present value of the principal is the 400,000 times the factor. So the present value factor in this case is taking the market rate of 4%, dividing that by 2 because it's a semi-annual payment, so 2%. Our periods are, we've got 10 years, but we're paying twice a year, so we double that and make it 20. So again, our two inputs, our I is, our I should have been 2%, not 4%, and our N should be 20 periods. So I'm gonna fix that so nobody is confused. So I should be 2%, our N should be 20 periods. Okay, there we go. So now if we went back to our present value table, we're going to see what these present value factors are. So we're looking for 2%, 20 periods. So 2%, 20 periods is 6730. Go back to our slides. We've got 6730. For the annuity being the interest payments, we've got 2% I, 20 periods. So we go back to the annuity table, 2%, 20 periods, 163514. 163514. Got that correctly. So the actual interest payment times the present value factor gives you 196,217. You put the two together, you get the 465,417. So when you issued the bond, the face value of the bond was 400,000, but the market is willing to pay you more than 400,000 upfront because the interest rate you are paying is higher than the market interest rate. So therefore, the investor gave you $465,000 of cash. So you go debit cash 465, credit bonds payable liability of 465,417. So like we talked about in the previous example, 465 is the ending number as your non-current liability. You could record it as showing a bond payable of 400,000, add your premium on bond of 65,417 as two separate lines, and then show the net as 465. Where did it go? Ran away. 465,417. Okay, so same logic as with the discount, except the discount, you have a reduced value of the bond. In the premium situation, your bond sold in the market for higher than the face value. Okay, so now when you're getting to your interest, again, you use the effective interest rate method. Using the effective interest rate method, your interest expense when you're in a premium situation your actual expense is going to be lower than the cash you paid because your market rate is lower than the face value rate or the coupon rate. So you calculate the same thing. You use the carrying value of the bond. So in this case, we start with 465,417 times the market rate times, in this case, semi-annual payments, so 6/12. You can do 1/2, gives you 9,308. But your actual cash payment was still $12,000, like it's been in every single example that we've done so far. So that's the credit cash that you've got. The actual interest expense using effective interest rate is 9,308. So therefore you have a difference, and that difference is now going to be a debit to your bond payable liability. Now, why a debit? Because you need to gradually reduce the value of your bond, which started at 465 and bring it all the way down to 400 after 10 years. And a debit liability reduces the value of your liability. Therefore, you are debiting the 2692. Go forward, you just do all of that again, except the only difference is when you're calculating the effective interest rate, you have to first reduce the carrying value of the bond to the new carrying value from when you started. So you started with 465,417, you reduce it by 2692. Therefore, your interest expense is a little bit lower. Since your interest expense is a little bit lower, your amortization's a little bit higher, but your cash payment of real interest remains the same. Okay? And then you go through the same process as before, where it gradually keeps reducing the value of your bond all the way till it comes down to $400,000. Okay, so we'll do another example or another practice question. So this is recording, what is this, E9-8. This time, hopefully, we will not need to use the formula. We could just use the present value table. So let me pull it up in Excel. Here we go. So E9-8. So on January 1st of this year, Bocchini Corporation sold a 10 million, so our principal is 10 million, 10, 3, 5, 6, $10 million. Our coupon rate is 8.25%. The bonds were also dated Jan 1, had a yield, so market rate of 8%, pay interest, so market rate is 8%. Pay interest each year on December 31st. So this is a single payment, so pay interest each December 31st. So frequency is annual. And mature 10 years. So term is 10 years. So prepare a journal entry to record the issuance of the bonds. Okay, so when we're trying to calculate the issue price of the bond, first thing we need to do is we need to calculate PV of principal, and we need to calculate PV of interest. Okay, so present value of principal, we know we need to start with the $10 million. I'm gonna open that up a little bit. All right, so present value of principal. We need, so our interest rate, which is a market rate, is 8%. Our N is equal to 10 years. And since it's a single payment, our 10 years is just going to stay at 10 periods. So therefore, our present value factor, if we were to go to the table, is 10 periods, 8%, is go down 8, try to get to here, which is 6.7. No, we're at the wrong table. We need to get to this table. That's why. So you got to make sure you're looking at the right table. So 8%, 10 years, we are 0.4632. So we're going to go back and write 0.4632. All right, so this is our PV factor. Then we go to interest. Interest is our principal times the coupon rate. Our actual interest payment is going to be $825,000 each year. Our inputs are going to be I 8%, and our N is going to be 10 periods again, same thing as before. So we go to the annuity table, and which is the second table. So go 8% and 10 periods, so 6.7101. Okay, 6.7101. So present value of principal is $10 million times 4632, which gives us 4632. And our present value interest, 825,000 times 6.7101. Remember, these 825,000 is simply your principal times your coupon rate. Okay, so the actual interest times the present value factor, and then in the factor is when you're considering the market rate and the payment frequency, things like that. Okay, so we've got 5,535,833. Now, remember, this is a bond where the market rate's 8%, we're paying 8.25%. Therefore, we expect to be issuing this bond at a premium because our bond is paying more than the market. So we expect more money than the face. So we need this number to be more than 10 million, and we have 10,167,833. Okay. So these are the inputs you needed. Okay, so now it said prepare the journal entry. So when we're preparing this journal entry, we're simply saying debit cash, which is a plus asset. You don't need to write the plus asset when you're writing it in an exam, but just, so you know the impact on the balance sheet. 167,833, and credit bond payable, which is a plus liability of 10,167,833. That's the entry you got to post, and then you're all set. All right, so that's the first part of the question. Then you get to the second part of the question, which tells you prepare the journal entry to record the interest payment on December 31st of this year. Use the effective interest rate method of amortization. Okay, so we know that for the effective interest rate method of amortization, we need to calculate first the effective interest rate. So the effective interest rate in this case is the carrying value. So we need carrying value, and in this case, our carrying value is 10,167,833. Then we need the market rate. Okay, so the market rate in this case is 8%, which gives us an effective interest rate or an effective interest payment of 813,427. So we know that when we do the effective interest rate method, our interest expense is the effective interest. So that's plus expense minus shareholders' equity of 813,427. We know that we have to pay actual interest using the coupon rate, and that's going to be the cash that leaves. So we know our credit is always going to be cash of actual interest that we pay, which is going to be the face value. Where's my mouse? The mouse has disappeared on me. Mouse is having a moment. But let's go this way. So our actual interest payment is face value, so our principal amount, times the coupon rate of 8.2%, which is 825. So therefore, our difference is debit amortization of premium, which is a minus liability. Okay, so this is reducing the liability of the bond, 825 minus 813, and that should balance our entry. So our amortization in this case is 11,573, and that's going to keep our entry balance. And that's simply saying that our bond started at 10,167,833. This is higher than the face value of our bond. We need over time to bring that 10.16 million down to $10 million. So therefore, at the first interest payment, we are going to reduce it by 11,500 so that it gets closer to that $10 million. You're going to keep doing this each interest payment until the value of the bond in the 10th year comes down to $10 million. That's about it. I think it's a good place to stop. The remainder of this lecture is another practice question where we'll do straight line amortization. We'll talk about issue costs. We'll do another practice question and then talk about ratios, after which we will be done. So a little bit more than I thought we would get through in this particular lecture, but that's okay. We will pick things up again in the subsequent lecture. Justin, did you have any more questions before we call it a day?
Yeah, Prof.
Yeah.
Can you explain one more time how we calculate the amortization for the last question? I was busy like doing all my Excel.
No, that's okay. So the amortization is just, where is let me share the screen again. Um, Amortization here is simply, so remember we said first you calculate the effective interest rate, right? So the
Yes.
effective
Yep.
interest rate is the carrying value of the bond at the time times the market rate, gives you the effective interest rate. Okay, so you always put in your debit interest expense as the effective interest rate.
Mm.
But when you are actually paying your investor out, you're going to be paying them using the face value, the principal, and the actual coupon rate, because that's what the terms of the bond are. So the cash that leaves is 825, which is the 10 million times 8.25% coupon rate
So
to
we
accrete the
just need
par.
to calculate the difference between interest expense and cash.
Exactly. So this is the
Oh, okay.
effective interest. This is the real interest. The difference between the two is your amortization. It's always going to be that.
Oh, okay. Got it. Got it. Thank you.
Cool. All right. Any other questions?
Um, I might need some time to study myself on this.
Yeah, for sure. So there's going to be lots and lots of practice questions on this. Again, this is the type of stuff that will show up on the midterm. But the questions get progressively more challenging. Just understand all the different things working together. We're going to do more practice again in the next lecture too. And then there'll be the tutorial, then there's going to be the practice questions posted, and then there'll be practice questions posted just before the midterm some more. So there's lots and lots of practice for this. Cool.
Okay, got it. Thank you, Prof.
All right. So that's it for this lecture. We will pick things up, hopefully barring any other snow days, next Monday. And then we'll go from there. Till then, thank you very much.
Thank you, Prof.
All right. Take care. Bye-bye.
Thank you.